The 40 billion math. OpenAI just crossed a $40 billion annualized revenue run rate, exactly double where they finished last year. Greg Brockman told staff that monthly revenue grew by 20% in July alone. Beneath that headline, the mechanics of how this company makes money have completely inverted. Last year, consumer subscriptions drove the cash. Now, enterprise contracts and API usage make up over 40% of the volume. They are transitioning from a consumer app into an enterprise infrastructure provider, but to hit those numbers, they had to change how they charge for compute. The volume race. The most critical part of this $40 billion figure is that it happened while the actual price of intelligence plummeted. Last month, OpenAI cut the cost of their GPT 5.6 Luna model by 80%. To double revenue while slashing prices, you have to push a massive increase in raw volume. They achieve this through agentic workflows, specifically the Codex coding agent, which forces continuous background API calls rather than single human prompts. You aren't just paying for the final answer anymore. You are paying for the thousands of background tokens the model burns while checking its own work. And they are burning those tokens at a loss specifically to box out their biggest competitor. The market share war. This revenue sprint is a direct response to Anthropic, who disclosed a $47 billion run rate in May. Both labs are now locked in a pure volume war, fighting for the exact same budget-sensitive corporate clients. They are subsidizing compute costs to capture market share ahead of their public market debuts, and that triggers a very specific financial cascade. The margin trap. A $40 billion top line masks the reality that the enterprise volume war and plummeting token prices make foundational models fundamentally a hardware subsidy. While API volume scales up, the raw compute expense to serve these models is scaling almost proportionally. In 2025, OpenAI posted a $38.5 billion net loss on $13 billion of recognized revenue. The real implication here is that neither OpenAI nor Anthropic can simply price their way to profitability. Because inference costs are dropping industry-wide due to open-weight models, premium labs are trapped in a cycle where they must constantly ship heavier, more compute-intensive agentic software just to maintain their current revenue per user. The immediate indicator to watch over the next 6 months is not top-line growth. It is the gross margin data in OpenAI's eventual S1 filing, which will finally reveal if selling artificial intelligence at this scale is a viable business, or just a massive capital bonfire. Subscribe for more